TreppWire Week in Review for the week ending February 23rd, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Stephen Bushbaum, research director, Ares Manzi, managing editor of Trepp subsidiary Commercial Real Estate Direct, and Emily Yu, Trepp research analyst. This week, we've once again seen the Dow and the S&P 500 hit new highs. And abroad, the Nikkei index set a new record that's been 34 years in the making. Meanwhile, FOMC minutes affirmed what the Fed has been signaling as of late. They are not yet talking about cutting rates. So what does this all mean for the CRE and CMBS markets, Stephen?
Well, this was an interesting week. And if I had to sum up the trend that we've seen with just two letters, AI, holy smokes. I mean, I have a little bit of indigestion about not buying NVIDIA stock, at any point during their massive rally. And so when I look at the equity indices and what's driving everything, it just seems like it's all an AI push. And what I have a hard time wrapping my brain around in the CRE sector is, okay, well, what does this mean for us? What outside of data centers does this mean? Is it going to be bad for office space demand? Is this, potentially a good thing for innovation? A lot of question marks there. So ultimately, when I step back and think about it, it's okay, the equity index is the equity indices, and the CRE market really right now is still very much rate focused. So with the FOMC minutes throwing yet more cold water on the rate cut expectations. If we look at the rate cut expectations, according to the CME Group FedWatch tool, I mean, these are some staggering numbers here. If you look at the expectations of a 25 basis point cut at the March Fed meeting, we were at roughly a 42% probability, is what traders thought was going to happen. A 42% chance of a 25 basis point cut was 1 month ago, was what everybody was betting on. That's dropped to 4.5%. So it's basically priced in that the Fed's going to hold in March. So we know that. So May was where we had the largest consensus of a Fed rate cut. So let me talk about this the other way. The probability the Fed holds rates steady at their May meeting was priced in at around a 16% probability 1 month ago. That's risen to roughly 73% as of today. So, these rate cuts that we had been so bullish on at the end of last year and beginning of this year, now are getting pushed out. And for those maturities coming up and what we've been seeing in the remit data, that pain is just continuing to roll through the sector, and we continue to price higher. So, it's great that the equity indices are rallying and AI is making this great push, but that doesn't really give me much satisfaction in the CRE sector.
And we also saw some jobless claim news and the latest PMI numbers this week.
Yes. So stepping away from the major headlines and looking at the macro news, jobless claims fell to a 5-week low of 201,000, showing yet more strong labor market muscle. I mean, this is great news for the labor market. But again, getting back to the rate cut expectations, we're not seeing enough weakness in the labor market. However, I will point to some economists' commentary that we don't need a weak labor market to help bring inflation down. So this is a good thing. I don't really see it as inflationary or deflationary, just yet more signs of a tight labor market. Then moving over to the PMI, the economy grew steadily in February, S&P finds, led by U.S. manufacturers. So this flash U.S. manufacturers Purchasing Managers Index rose to a 17-month high of 51.5, aided by the strongest increase in new orders in more than a year and a half. So this is great news for the manufacturing sector, again, showing little signs of the type of economic cooling that had been, I think, somewhat expected across the board. So some very good news there.
So let's turn to our property type segment, and this week we'll start with office. Now, Arest, you've written a lot of commentary recently for our Rundown newsletter surrounding the office market and specifically about the fear-greed scale, which is an index that measures how emotions influence how much investors are willing to pay for stocks. So last week you wrote that players in the commercial real estate market are now in the greed portion of the fear-greed scale. And this week, we saw a solid example of this with a new investment manager buying an office in Seattle. Can you walk us through this?
Thanks, Haley. So Palisade Group, founded by 3 former equity office executives, they formed their company in the middle of last year, completed their first transaction paying $47.5 million for this property in the South Lake Union area of Seattle, which is if you've been to Seattle, it's kind of like a tale of two cities. You have downtown Seattle, which is kind of not very nice right now, but the South Lake Union area is quite nice. There's a lot of residential, a lot of retail, a lot of offices. This property is 65% occupied, so it's not yet stabilized, and that's their play. It's kind of like a hot area, or it had been a hot area before COVID and before the lockdowns. It's 1,000 and 1,100 Dexter Avenue. Buildings nearby, that area has a 10% vacancy rate. So they're counting not only on the building getting up to market vacancy, but Apple has space there. All the big tech companies do too. So it's a play on, you can't paint the office sector with a broad brush, right? You have to pick your targets and pick your properties very carefully. And they expect to do quite a lot of that. They told us that they've got a pretty hefty pipeline, but it's not like they're going to be buying, 50 or 60 buildings in short order. It's going to be a very pedantic, they're going to have a very careful approach to what they're doing. And we've seen others do the same thing.
So, Arrest, for some of our junior listeners out there, I look at Equity Office and I remember just how big that 2007 transaction was. Can you give us a little bit of history there on why these players are very well positioned to be doing exactly what they're doing right now?
Great point. If you ever want to see when the top of the market was, look to Sam Zell. Sam Zell was running Equity Office at the time. He sold at the absolute top of the market. I know you're not supposed to be able to time the market very well, but he had a knack for doing so. He sold at the top and bought at the bottom. He was, the grave dancer. You would think that the Equity Office standard basically filtered down to these three guys.
Love it. Yeah. So in other words, these folks are familiar with buying low, selling high, trying to time the market. And for me, the signal I take away from this story is for folks like this to be making tactical investments in offices that, some people are shunning, tells me we're at that really interesting point in the cycle.
That's for sure. So office is facing at least two major headwinds. One is a structural change. A lot of companies are allowing the whole work from home or hybrid work concept has become permanent. That allows companies to reduce their effective footprints in buildings. And number two is there's a liquidity crisis in the sector. Lenders just don't want to lend against most office properties. But Class A properties, the best properties in any area rather, perform very well. I mean, all you have to do is look at the Hudson Yards area in New York. It's thriving. But then go to a mid-block Times Square area building, and it's probably not going to be performing so well.
That story you just ran through was one of our big picture stories from the rundown. So for any of our listeners out there who want to stay in tune with the markets and on top of what we're looking at, please reach out to podcast@trepp.com and we'll get you signed up for the rundown. We had one other story in the rundown this week in our big picture about office property values not hitting bottom. And while I won't unpack this full story, I will say we dig through a lot of the data behind some of the repeat sales indices and, ultimately what's going into those forecasts of where property values are going. Certainly office properties have not hit bottom in certain markets, in certain geographies. That being said, that's a beautiful segue into what will be our first office property story this week.
Yes. So the first story we'll talk about here is about a $115 million Peachtree Center CMBS loan. This week, we noted that the property behind that loan, which is an office and retail complex in Atlanta, saw another sizable reduction in its appraisal value. So, Emily, I know you have those details. Why don't you break it down?
So the Peachtree Center has been reappraised at a value of only $155 million. This 2.48 million square foot property was actually taken through a foreclosure in September 2022. So this isn't the first time the appraised value has dropped. The Peachtree Center was first valued at securitization at $260.8 million. And the last time we really dove into this loan, its appraised value was lowered to $192 million. So this time it's been reappraised at $155 million. To give a little bit of background on the history of this loan, the loan was transferred to the special servicer in early 2022 as its April 2022 maturity was coming up, and the borrower had indicated that they wouldn't be able to pay off this loan. Now, later on in November 2023, this loan was actually transferred to a different special servicer. To take a look at the financials on this loan, the most recent of which are from the first half of 2022, the DSCR based on net cash flow was at 1.26, and that is when the occupancy was at a mere 50%. So the property itself, this collateral consists of 6 office buildings and 1 retail building, and these were all constructed between around 1969 to the late 1980s. And the top 2 properties behind this loan are the Marquee 1 tower and the Marquee 2 tower. Now, to give a little bit of a big picture of the Atlanta office market, the Atlanta office market has a 23.8% vacancy rate, and that's according to Cushman & Wakefield. It suffered from a 2.5 million square foot negative absorption, and the downtown market, which is where this Peachtree Center is located, has a 25.2% vacancy rate, just above that Atlanta office market vacancy rate.
And just to give a little bit more color on the Peachtree Center loan, this was originally in a pre-GFC CMBS deal. So this is not this loan's first go around with distress. This had run into trouble in the GFC, the early 2010s, and ultimately got worked through, put back in the system, so it's back in the same place again. So if we step back from this and think, all right, what does this mean for the office market and the signals we're taking for the market? The good assets are performing well. The assets that have run into trouble in the past are, in some cases, the ones that we're seeing again enter the distress cycle.
Interesting thing. We had written this week about Capital Economics forecasts that office values would decline by 43% from their peaks. If you take a look at the Peachtree Center, it's down 41%. Now, the question is, what was its peak value? That's from a 2018 value. The property has not performed well, even through the run-up in values going into 2022. So it's probably down 43% from its peak.
And, it seems like we're going to get a lot of mileage out of this story. So I'm just going to pile on here. Earlier this week, we were writing up some TreppWire stories, and I was doing some back of the envelope calculations for an office portfolio that just had a reappraisal done. And this portfolio is split between the Atlanta MSA and Chicago MSA. And the Atlanta assets were reappraised anywhere between about 15 to 35% lower from their securitized values versus the Chicago part of the portfolio was down. I want to say it was like 60 to 70%. So really dramatic bifurcation that portfolio performance. But then also this was the Alpharetta part of the Atlanta MSA. So if those of you that aren't familiar with the Atlanta MSA, Alpharetta is a northern submarket. If you go right up, the road's called 400 North, you get to the Alpharetta market versus Peachtree Center is downtown. And so, to see that sort of reappraisal differentiation with the Peachtree Center coming down in the 40s versus the northern submarkets performing relatively better on a reappraisal basis, still both experiencing some distress, but bifurcation within the market as you typically expect, right? We have geographic segmentation within commercial real estate.
So turning to another story, this week we also saw the value of a Chicago office building continuing to drop.
Right. So the trends that we're seeing aren't limited to the Atlanta MSA, as we would imagine. So the value of the collateral backing the 149 million Civic Opera building loan was cut again this month, and that's according to our February remittance data. So the appraised value was cut to just under 120 million based on a December 2023 appraisal. Now, similar to our previous stories, this isn't the first appraisal cut that this property has received. At securitization in 2015, this property was valued at 214 million, almost 100 million more than the most recent appraisal value. But over the course of 2021 through 2023, the appraisal value was cut several times. Now, this most recent appraisal value represents a 7% haircut to the second most recent appraisal value of 128 million in the second most recent in April 2023. So to give a little bit of a background behind the property, this is a 915,000 square foot office in Chicago, Illinois. And this loan has been with the special servicer since June 2020. And the most recent DSCR for the loan was at a mere 0.26x as of the first 9 months of 2023, and occupancy was also low at 75%. Now, the loan is split between two CMBS deals. Part of it makes up 11% of a 2015 deal, and almost 70 million makes up almost 10% of a 2015 deal. This week, we released another trading alert about KPMG looking to sublease 1/3 of its space in the Dallas office tower called KPMG Plaza at Hall Arts. Now, KPMG occupies around 200,000 square feet, or just about under 45% of the total space in this office tower. This most recent news is that the firm is putting up about 63,000 square feet up for sublease. This loan on the property, it is a $111 million loan, and it's been current on its payments for its entire loan life. And it doesn't mature until January 2030. KPMG's lease as a tenant at the property expires in July 2030. Now, the most recent financials for the full year of 2023 shows that the loan posted a DSCR of 2.44x when the occupancy was 90%.
So just to dig into a little bit more detail on this story, this is an alert that could go one of two ways. I mean, if we're really being honest, this could go one of a number of ways. But let's just say this could go one of two ways. This might be a non-event because we know Dallas has had decent demand. However, when I was digging through some details in the prospectus here, I came across some very interesting details. KPMG has a one-time right to terminate its lease for the entire space effective July 2025 with 12 months notice and a termination fee of $12.8 million. They also have an option to reduce their leased space by up to 26,000 square feet or one full floor effective July 2025 with 12 months notice and an estimated contraction fee of about $593,000. KPMG also has an option to reduce its lease space by up to 26,000 square feet or one full floor effective July 2025 with 12 months notice and a contraction fee of $593,000 if it vacates the 16th floor only, or $781,000 if it vacates the 7th floor only. Now, while we're speaking of termination options, it's worth noting that there are a few other termination options on this building. So the second and third largest tenants also have termination options. The second largest tenant at this building is Jackson Walker, who occupies about 108,000 square feet, or just over 23% of net rentable area. They have a one-time right to terminate their lease effective January 2027 with 12 months notice and an estimated termination fee of $3.6 million, as well as options to reduce their footprint. The third largest tenant, Bill Nunley, has about just under 42,000 square feet or 9% of net rentable area, and they have a one-time right to terminate their lease effective July 31st, 2029 with 12 months notice and an estimated termination fee of $4 million. I would say the third largest tenant, that's a good ways off. I'm not too worried about that termination option coming into play, but with KPMG having those embedded options coming up, if this sublease stays on the market long enough, we might see KPMG say, you know what, we're going to exercise that termination option, reduce our footprint, and then depending on what office space demand looks like, we could see more space follow. I wouldn't say this is one to lose sleep over yet, but these are certainly very salient details we wanted to make sure we got out in our trading alert for this building.
Okay, so moving on to another property type where we saw some themes this week, and that is in retail. Arrest, you were writing this week that the shopping mall sector is not quite out of the woods yet. You noted that if anyone's been keeping a watchful eye on the latest quarterly filings of the country's large shopping mall owners, you may think that the mall sector is thriving. But of course, not all properties are created equal. So walk us through what you've been watching.
Sure. So the thinking has been that the chaff had been separated from the wheat, right? I mean, you look at the Simon Property Group, which owns 195 properties. NOI has topped 2019 levels. Turn to Macerich, they saw more leasing than they've ever seen. Same thing with Tanger Outlets. But as you said, not all properties are equal. There's still some trouble spots. A lot of that has to do with maturing mortgages and cash flows that still haven't reached levels needed to refinance those maturing loans. A couple of examples of the Miami International Mall in Miami, of course. It's $159 million mortgage matured, wasn't refinanced. Why is that? Well, the property's not generating the cash flow it needs to. I think, cash flow is about a quarter less than what it had been in 2019. I believe it's about 75% occupied right now. There's a property in Hawaii, Queen Kahamuhana, and I know I mispronounced that. That is now in foreclosure. It had been taken in foreclosure in 2022, and its value has been cut by 2/3 to just less than $39 million. And then let's go up to Massachusetts, Holyoke Mall. It continues to struggle. It's got weak occupancy, weak cash flow, and it's facing the maturity of a $166 million mortgage. It also has a $35 million mezzanine loan, and that could be the issue there. The mezzanine loan, whoever holds that loan, we don't know who does, has declared that loan to be in default. So something's got to give there. Either the owner comes up with additional equity or something happens. That's just a partial list. Emily here will talk about the Killeen Mall near Fort Hood in Texas.
Sure. So the $78.6 million Killeen Mall loan was resolved with a loss, according to our most recent data. So 78.6 was the most recent balance before this loan was resolved. And the mall behind the loan was the last remaining collateral behind a 2008 deal. This mall is a 386,000 square foot regional mall in Killeen, Texas. And this REO asset was built in 1981 and renovated in 2005. This loan was transferred to the special servicer in June 2017 for imminent maturity default. According to the servicing commentary on the loan, the trust took title to the property in February 2018. Now, this property has a number of big box retailers at it. To call out one, Sears, which is no longer at the property. Sears rejected its lease in 2019 after the company filed for bankruptcy and closed its store at the Killeen Mall in March 2019. As servicing commentary suggests, Dillard's has backfilled this 82,000 square foot space. The property is also about 94% leased, and the trust's property is about 92% leased. And these two figures are as of November 2023. So the property was appraised at a value of about $100 million at securitization, and the values dropped several times in recent years, with the most recent value being under a third at $32 million in late 2023. Now, to talk a little bit about the details of the loan resolution, the loan was resolved with about $50 million in realized losses, with proceeds at around $29 million and expenses around $1.4 million. And the loss severity from this resolution was about 65%. Now, we'll probably be mentioning this loan in our beginning of month loan loss report to recount the most recent and largest loan losses, so keep an eye out for that.
Just to point out, the location where Killeen Mall is, Fort Hood, there's 53,000 active duty troops. And it's the only mall in that area, which works towards its benefit. The resolution valued the property, if I'm not mistaken, at close to $31 million, which is a substantial haircut when compared with the close to $80 million loan against it.
Yeah, this makes me think about a story I read maybe about a month ago or so about zombie malls. So malls that had been liquidated, their value cut to such a dramatically low level that at a basis like this, call it around 30 odd million, if you're buying this asset, you don't need much of the tenants left in this asset to continue paying rent. So if you have Dillard's, a couple inline tenants, sure, your occupancy could be pretty abysmal by relative standards, but it would still be cash flow positive if you're buying it at 30 million and treating this as somewhat of a long-term land play. If ultimately you think there's a need for this to be redeveloped. But on the flip side, you have that optionality baked in that if you do attract more tenants, there's a lot of upside potential and you have multiple off-ramps here. So up next, we have an Oregon retail center selling for $35.3 million. A venture led by Horizon Group Properties has paid $35.3 million or $138 per square foot for Lincoln City Outlets, a 255,000 square foot retail property in Lincoln City, Oregon. The property was built in 1989 and it is located at 1500 Southeast East Devils Lake Road. Quite a mouthful. Along Oregon's coastline and half a mile from Lincoln City's downtown. It is occupied by more than 50 tenants that include Nike, Coach, Pendleton, North Face, Eddie Bauer, Scott Northwest Trading Company, Salt, and Point Break Fitness. Lincoln City Outlets has been owned by Singerman Real Estate LLC of Chicago, which had acquired it in 2014 for $39.5 million. So to wrap up our retail segments, finally, we have the appraised value of Chicago retail shops cut again. The value of the collateral backing the $57.7 million Palmer House retail shops loan has been cut again. The prior appraised value was already below the loan balance, so the new reduction puts the loan deeper underwater. February remittance data shows a new value of $24.7 million for the property based on a June 2023 appraisal. The new appraised value is roughly 33% below the previous appraised value of $36.9 million that came out in 2022. The property was originally appraised at $92.6 million at securitization, so dropping pretty substantially. The Palmer House Retail Shops is a 135,000 square foot mixed-use property that was built in 1929 and renovated in 2009. The shops are located in Chicago, Illinois. A foreclosure sale was executed in September 2023, where it sold for $29.5 million. According to servicing commentary, collateral performance deterioration has occurred over time due to COVID, tenant bankruptcies, as well as general retail submarket declines. The most recent financials are from 2022 and show the debt service coverage on net cash flow basis was 0.28 times, with occupancy at 55%. Servicer commentary indicates that performance as of July 2023 is similar to that of 2022, with a debt service coverage ratio of 0.24 and occupancy of 55%. This is the third largest asset in a 2015 deal, making up about 8% of that deal, and this is also in CMBX 9.
Now let's turn to our multifamily segment. We had a lot of stories about apartment sales across the country and new financing that's been lined up, so let's break those down.
Sure. First up, we have Port Charlotte, Florida apartments sell for $66.5 million. A venture that includes Image Capital is paid $66.5 million, or just about $252,000 per unit for the 264-unit Charlotte Commons apartment complex in Port Charlotte, Florida, according to RE Business Online. It bought the 2-year-old property at 24150 Beatrix Boulevard from SC Boldner. JBM Institutional Multifamily Advisors brokered the deal. The property, about 32 miles north of Fort Myers, Florida, has studio, 1, 2, and 3 bedroom units with monthly rents between $1,600 and $2,300, according to apartmentfinder.com. Next up, we have Denver apartments selling for $124.25 million. Brixton Capital has paid just under $125 million, or $353,000 per unit, for the 352-unit Windsor apartment property in Lakewood, Colorado. The Solana Beach, California investor bought the property at 8153 West Eastman Place, some 12 miles from Denver, from TA Realty of Boston. The property was developed in 1997 by Carmel Partners and last sold in 2012 for $65.5 million. The apartments will be rebranded Brixton Townhomes at Bear Creek and will undergo renovations. Units are laid out as flats and townhomes with up to 3 bedrooms each. Units have 9 and 10-foot ceilings with crown molding, gas fireplaces, and attached 1 or 2 car garages. They have an average of just over 1,100 square feet. Some have quartz countertops. Sound nice. Up next, we have Berkadia lines up $44.5 million loan for California apartments. Berkadia has provided a $44.5 million Freddie Mac financing against the 270-unit Fountains of Fair Oaks apartment complex in Fair Oaks, California. The 5-year loan allowed Erslow Company, Calabasas, California, to retire a roughly $35 million Freddie Mac loan that was slated to mature in October and subject to a 1% prepayment penalty. Fountains of Fair Oaks at 4800 Sunset Terrace was built in 1976 and renovated in 2012. It was on track to generate $3.22 million of NOI last year, up from $2.07 million it generated in 2014.
We have another financing story in the multifamily sector where Northwind Group has lent $111 million against some Houston condos. Now, this is the Hawthorne, a 67-unit residential condo building in Houston's exclusive Tanglewood neighborhood. The 17-story building was built by a venture of Pelican Builders and Ember Group. The property has units from 2 to 4 bedrooms each and up to just over 3,000 square feet. And the property is just about to be completed. Roughly 37 of these units have already been pre-sold. Northwind's loan is designed to fund construction completion and will start to be paid off just as units get sold. Units have been seen to be offered at prices starting at $1.73 million. The property offers concierge services and includes a fitness center, a swimming pool, and units are outfitted with sub-zero refrigerators, Kohler brand bathroom and kitchen fixtures, tile kitchen backsplashes, wide plank hardwood flooring, and balconies. That sounds fancy. The Pelican Ember venture was represented in the financing by CBRE.
No, Sub-Zero is a really nice refrigerator.
Very expensive.
Yeah. And they break down all the time. So if you have a choice, don't get one. But they're nice. I mean, you tell your friend you have a Sub-Zero, that means you got something, but they break down.
So last week, to close the week, we sent out a trading alert to our clients. This regarded the lodging sector. We saw a 2-alarm fire at a Houston hotel.
Yes, so this was a rough one. A 2-alarm fire broke out at the Marriott Houston West Chase the night last Wednesday, February 14th, according to Fox 26 Houston. Smoke was reported on floors 6 and above, and 140 firefighters were called to the scene to assist with evacuations and getting the fire under control. Fortunately, no injuries were reported, and the cause of the fire is under investigation. This news comes right after the February remit data showed that the workout code for this loan had changed. The prior workout code had indicated that the special servicer was pursuing foreclosure, but the new workout code in February shows the strategy is now a note sale. The collateral for the $69.9 million Marriott Houston West Chase loan is a 600-room full-service hotel located at 2900 Briar Park Drive in Houston. The collateral was valued at $135 million in 2007. The value has danced around quite a bit over the years, moving higher and lower at various points. The collateral is currently valued at $37.5 million. The loan was originally slated to mature in late 2017. The note was modified in the spring of 2018, with the maturity date being extended until 2021. Less than a year later, the loan went back to special servicing, with the borrower looking for a second modification. That second modification pushed the maturity out to 2023. However, the loan has not seen a payment since September 2020, according to servicing data. And this loan makes up 100%. So this is the sole remaining loan behind a 2007 deal. And just a little bit of additional color here that we didn't put in this trading alert. There was a lot of deferred maintenance at this hotel that has occurred. So two of the big items that stood out to me was the roof needed to be completely replaced. I think that has gotten underway and the special servicer got it approved. But also one of the two chillers had gone out. And so they brought in a temporary chiller for this property. And so Arrest and I were talking and we're wondering if that temporary chiller had anything to do with the fire. But the good news is, according to reports, nobody was injured. But this certainly may complicate the special servicer's workout strategy here for a note sale.
And finally, we saw a Pennsylvania industrial property sell for $78.5 million.
Yes, this 812,000 square foot warehouse at 360 Independence Avenue in Mechanicsburg, Pennsylvania, near the state's capital of Harrisburg, has changed hands for $78.5 million, or nearly $97 a square foot, according to Commercial Observer. The property was acquired by a venture of Lightstone Group of Lakewood, New Jersey, and Cerebus Capital Management in a deal arranged by JLL Capital Markets, which also arranged a $65 million financing provided by Argentic Investment Management. The property is within the Upper Allen Business Park near Interstate 76 and US Route 15. Just to go back to our last couple of weeks of industrial stories, at $97 a square foot, I mean, this looks like a bargain compared to some of the prices we were seeing on the West Coast of $300 a square foot. So, good to see we got another industrial transaction in the TreppWire podcast here.
Lonnie will certainly appreciate those numbers. And before we turn to shout outs, I have a few programming notes this week. If you are an early listener, which means you're tuning in before 1 p.m. Eastern on Friday, the 23rd, you still have time to register for our Market Pulse webinar. Lonnie and Steven will be breaking down CRE maturities, the latest valuation trends, and some of the findings from bank earnings. So send us an email to podcast@trepp.com. We'll get you signed up for that webinar. Or if you sign up and can't attend, we will be in touch and we can share the recording once that's live. And over the past few weeks, we've been mentioning several of our open roles at Trepp, but there are a few more that we haven't talked about yet that we wanted to share today. We also have a position open on our account management team. So we're looking for someone with experience in the CMBS industry to join our team who will be in charge of managing and expanding our client relationships. If you're interested, please send us an email to podcast@trepp.com. We also have roles open on our research team, working with Stephen, Emily, and others in our sales department, and also on our lending and banking side of the business to work on our product and advisory tools. So if you're interested, check out our LinkedIn, check out our careers page on trepp.com, or send us a note and we'll put you in touch with our HR team. And then turning to shout outs, we had a lot of people reach out this week requesting some of our reports and webinars. So thank you to all of you. Matt W. is a big fan of the podcast and he loved the industrial shout outs on last week's pod. So I hope, Matt, you're also subscribed to the rundown because we do cover some stories there as well. Mario G loves the podcast, and Mike A requested some of our office content. John R said it's always a pleasure to listen to our informative shows. Sam S is a 20-year CRE valuation business veteran, and he said this is one of the only publications he's run across that has a smart, realistic, balanced view across asset classes and the industry as a whole. So thank you very much, Sam. That was a great compliment. Ian C is a recent podcast listener and is interested in receiving our newsletter, so we signed you up for that. Micah B said our podcast is awesome. Keep up the great work. Nick E thanked us for all that we do and putting the podcast together. He said it's an incredible resource and we keep it very entertaining. Erica A was interested in some of our WeWork commentary. So if you missed any of our topics about WeWork, or if this is something you weren't really following, Trepp has been tracking this and the exposure in CMBS since 2019. So if you want any of that, we can share that with you. Frederick C sent us a suggestion to round up some more stories and talk about what's happening in the world of subleases. So that's something we are always tracking and talking about, but we can definitely make a point to have that as a segment on an upcoming episode. John B sent us a great photo of his dog Copper, who he said is also a fan of the podcast because they listen together on their walk. He also asked us to talk more about the debt yield underwriting standards for some of the CMBS loans. So that's something we will definitely work in when we have those details. And our friend Louis B reached out just to say he hasn't talked to us in a while and he wanted to make sure we knew that he's still listening and to keep up the great work. So we always appreciate hearing from you, Louis.
And one more shout out. We have A. Gupta from NYU. He was in our Trepp offices this past week and said he was a big fan. So a big thank you to A. Gupta from NYU. Had a lovely conversation.
And then a shout out to you guys, Arrest and Emily, for standing in on this podcast. Lonnie's out today, but he'll be back next week. But we appreciate you guys and jumping in and adding your market commentary.
Anytime. Thank you.
It was fun.
And we'll see you all next week. So with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.